We've got Susan. Looks like I'm losing. Portland, Oregon. Hello, Susan. That's an old Buckingham song, by the way. How's it going?
Oh, good. What I was wondering was, are you still recommending the non-traded REITs given our economic situation, and can their values remain what they are?
I am still an owner of non-traded real estate investment trusts. I still discuss them. I think they're still a tool, a reasonably good tool, I would say, for income in a portfolio, but only for those people that actually understand how they work and how valuations are done. So let's talk specifics. The answer to the easy answer is I still would recommend certain individuals acquire non-traded REITs in lieu of bonds in a portfolio. How's that?
Okay.
So tell me about what you're thinking of.
Well, I have some, and one has lost 33% already.
How do you know it? Wait a minute. How do you know that it's lost 33%?
Well,
have you sold it? What did you sell it?
No, I didn't sell it.
Okay, well, hang on a second. So if you bought a 15-year bond for $100,000, and interest rates went up 2 percentage points, which they certainly could today, couldn't they?
They could.
And that 15-year bond, if you were forced into selling it that day, was only worth $67,000. Then if you sold it, you would have lost 33%. But if you hold that bond until maturity, how much money do you get? You get your $100,000.
Right.
So the question is, no sale has been made, therefore no loss has been incurred. What has happened in the non-traded REIT business, obviously you bought yours when I bought, I don't know which one it is, and I don't want to talk about it. That's a pretty good size haircut. But what has happened in the real estate, commercial real estate business is it's sort of gone the way of the residential real estate market. What's happened to the value of your home?
Down.
Down. What's happened to the value of commercial real estate all across the country?
Down.
Down. Why is the commercial real estate market prices, why have they plummeted? Do you know?
So many people out of work and lost their business.
Yeah, that's a little bit of it. The unemployment rate has caused this enormous recession in real estate because what's happening is businesses are not willing to pay those high prices for rent. And so here's what happens, and I think this is going to make clear this whole discussion on valuations. So let's say this building that I'm sitting in right now, and let's say I was paying $3.50 per foot per month for rent 2 years ago, 3 years ago. And that was a competitive rent 3 years ago. And my lease is coming up for renewal today. And let's say that I have 20,000 square feet. The tenant is me. The landlord is some real estate investment trust, which is true, by the way. The landlord comes to me and says, your lease is coming up for renewal. We need to negotiate. And I say, you better believe we need to negotiate because I can move across the street and get $2.75 per month rent. I could save 75 cents per month per square foot. So what do you think my landlord is going to do?
Drop it.
Drop the rent. What does that do to the landlord's net operating income?
Lower.
It lowers it. So real estate is valued based on the net operating income and the appetite, if you will, for real estate in the marketplace, both of which have come down in the recent past. So right now, if the landlord wants to keep this building 100% occupied, they're going to make me a deal. If they want to play hardball, I'm going to leave, and then it's going to cost them way more money because the next person that comes in wants tenant improvements, wants free rent, wants all kinds of stuff. And so what they're going to do is they're going to hoard cash in the unlikely event that I leave at that price, and they're going to lower the rents. Hoarding cash means they might not have that 7% dividend to spend. They have 6% or 5.5% to give you instead of the average public REIT that's paying 3%. And because their net operating income came down, the valuation of the property goes down as well. One last thought on this, and then I'll let you speak. The Financial Industry Regulatory Authority a couple of years ago introduced a a new valuation methodology whereby every non-traded real estate investment trust must do what is called a mark-to-market valuation of the real estate 18 months after the money raise. Now, if you and I bought a building together and we had to value that building 18 months from now at fire sale prices, in other words, mark-to-market means I got to sell it today, do you suppose we could sell it that day for what we paid for it 18 months ago in this real estate environment?
No, no.
So what you're seeing on your statements is a valuation. They have to do an honest valuation. And if they did need to sell that property today, just like a bond, if you need to sell that bond today after interest rates have gone up, you're taking a haircut. If you need to sell your non-traded REIT today, you're taking a haircut. But when you bought it, I hope you bought it with a long time horizon in mind. Now, when the investment advisor sold you a non-traded REIT, did they tell you this was a trading vehicle, or did they say this was part of a long-term bucket?
Is your opinion that they could go completely broke and you could lose all your investment?
No, I don't think the respectable non-traded REITs with low leverage could go completely broke, because remember, we're talking about real estate. Are you receiving a dividend?
Yes.
Yeah, so if they're paying you a dividend, it means they're making money. They, by law, have to distribute to you 90% of their pre-tax income. So, no, I don't think that they could lose all their money. I don't know of any that and I've invested personally in 7, 8, 10 of these things. And some of them I've done very, very well on. Some, like you, that were bought in the last 4 or 5 years when the valuations came in have come in a little bit low. But I didn't buy them with a 3 or 4 or 5 year time horizon.
Right. So they could go back up.
Oh, absolutely. I would expect that. I would expect them to go back up, because rents aren't going to be this low forever. Remember, if I paid $350 a foot 4 years ago and I'm paying $275 today, it's likely that I'll at some point be paying $350 a foot again, right?
Yes.
When that happens, net operating income goes up, the appetite for real estate is more robust, prices come back up.